The multifamily market has changed, and right now there's a big discrepancy in the way 2 to 4 unit buildings are being priced in the way 5 unit and up apartment buildings are being priced. And if you can recognize these changes and take advantage, you could set yourself up to do really well in the future. I'm Cody Charnell. I'm a multifamily broker here in Long Beach, and today we're filming episode 3 of the How to Analyze a Rental Property series. We're going to be looking at a 6-unit building that recently sold here in Long Beach. We're also going to talk about these changes in the multifamily market. The video is broken up into 4 sections, so we're going to look at location, property details, the numbers, and then the market discrepancy that I just mentioned. If you get any value out of this video, please remember to like and subscribe. And without further ado, let's get into it. So the property we're looking at today is 1465 Henderson Ave. And the reason I chose this building is it's one of the lowest priced 5-unit and up buildings to sell within the last year. And it's also the only fully renovated property in that category of low price 5-unit and up buildings that have sold recently. So for someone looking to get into the 5-unit and up investment space, I think this is a great starter type property. It's located in a neighborhood called Washington. Washington is going to be one of the most affordable neighborhoods in the city. That's from a rental perspective, so you're not going to find a place in Long Beach that has more affordable rents than here, but also from an investment perspective. So you're going to have some of the best metrics when you're looking at investment properties, so highest cap rates and lowest gross rent multipliers in a neighborhood like this, which allows you to use the most leverage. So you can use the biggest loans, the lowest down payments in an area like this. And when we look at Washington more closely, it's sort of split up into 2 sections. So the half of the neighborhood to the left here is going to be all industrial. So there's warehouses and different industrial stuff going on. And then to the right, it's all residential. But there is some good stuff happening in the neighborhood. If we go to street view here, we can see a recent development. So this property is called Bloom at Magnolia. It was completed within the last year or so, and this is a 40-unit affordable housing development. So there are big companies spending money to build new housing in this neighborhood. To the south of the neighborhood, we also run into Long Beach's Midtown Specific Plan, which is an area where the city is encouraging high development. So the Midtown Specific Plan encompasses part of Anaheim here and also goes up Long Beach Boulevard, where the Metro line is. And if we go to street view, we looked at this in past videos, but we can see some redevelopment of older buildings. And this has been turned into a rock gym, which stuff like that was not in this neighborhood before. We also have big developments like this. And then looking at the industrial side of the neighborhood, most people would think that being in an industrial area or industrial adjacent area, there's not going to be much happening on that side of the neighborhood that would make the neighborhood feel better or more interesting to live in. But there is one project that I wanted to point out. This is called the Daisy Diner. This is an old warehouse that was converted into a commercial kitchen. And basically there's, I think over 20 restaurants that operate out of this and just sell food to go. So you can go on their website, order from a bunch of different restaurants and pick up food here. So as I mentioned before, this is one of the most affordable neighborhoods in the city. And some people are deterred by that. They don't want to invest here because it's not super pretty. It's not something that they want to drive their friends by. But as I mentioned before, your money is going to go the furthest here. And there's also a huge need for this type of housing. And it's very hard to develop more of this type of housing. So from an investment perspective, if the economy isn't doing well, you're going to have more pressure on this type of affordable housing. So you're always going to be able to fill up these types of units. But this is our subject property here. You can see Henderson is a one-way street, so kind of a narrow street, but luckily there's parking on both sides. It is dense, so you're going to have mostly multifamily properties in this neighborhood. And basically like a pretty no-frills type of neighborhood. But workforce housing like this is in very high demand. This is the back of our property, and luckily there is some off-street parking. But with that, let's take a look at the property itself. So this is the MLS listing for this property. And just a little disclaimer, I wasn't involved in this transaction. So congrats to the agents who were able to put this deal together. I think it was a great deal. But as I mentioned before, 6 units. This property sold for $1.299 million. It was listed in December of 2023 and it ended up closing in January of 2024. And it was on the market for just 15 days, which is unusual for a 5-unit and up building right now. It's tending to take longer for these types of properties to sell. So they were able to get this one sold pretty quickly, and I think a lot of it has to do with how they priced it. But you can see just how much work has been done to this building. So you have new fence. It looks like they've updated the windows. It looks like new paint, and looks like 3 units down, 3 units up, which is very common for a 1950s building. The property consists of 5 1-bed, 1-bath units and 1 2-bed unit. And as I mentioned before, there is some parking in the rear. These 2 doors are kind of little bonuses. So one of the rooms is a storage room, which is actually rented right now for $150 a month extra. And then the other room is a laundry room, which isn't currently being utilized, but a new owner could install coin-operated machines and increase the income a little bit. The listing also mentions that the current owner is not charging for parking. So there's 5 parking spaces here, which a new owner could charge for and generate a little bit more rent. And this Washington neighborhood is very parking impacted, so I don't think it'd be hard to get rent for these spaces. And you can see the interiors of the units. All 6 of them have been fully renovated like this, and they did vinyl plank flooring. You have an open concept kitchen and living area. You also have new kitchen cabinets, quartz countertops in the kitchen, a nice vent above the stove, more modern lighting here. And going into the bathroom, you can see they did new tile surround, new tub, vanity, and toilet. Really not a lot of frills, but very appropriate finishes for a unit in this neighborhood. This is going to allow you to get the max rents for these types of units. And because all of this has already been done, this is going to be a very easy property for someone to take over and just manage. So you can see, scrolling down on the listing here, current rents. So the 2-bed unit is currently rented out for $17.95, and they're saying that that is market rent for a 2-bed unit in this building. And the 5 1s are currently rented for $15.50, and they're saying there's a little bit of upside on those, so you can raise rents about $45 per unit and get them up to $15.95, which I think these are conservative, so we're gonna roll with those. Okay, now let's take a look at the numbers. So this is my pro forma for this property. In this section here, we have our purchase price of $1,299, some building details. We also have a vacancy rate and property management expense built in here. Down here, we have the current rents and our market rents. And then at the bottom, we have some additional income. So our storage room that's generating $150 a month. And then we're gonna say $75 for each of those parking spaces. So someone could start charging for those. And I think the most important section here is the financing section. So when you're qualifying for a loan on a 5-unit and up building, lenders tend to look at the building like it's a business, and they make you put enough down so that the business is cash flowing from day one. So a building like this that already has strong rents in place is going to allow you to come in with the lowest down payment. So there's not a lot of room to add value to this building. You know, a lot of people target value add deals, but when you're in the commercial space, it's sort of a double-edged sword, because if you're buying a value add deal that has really low rents, it's going to be hard to get conventional financing with a low down payment. And in a lot of cases, people are having to use bridge loans for that type of property. So if you're looking just to start out in the 5-unit and up space and you don't want to go for a high interest rate bridge loan, something like this could be a good option for you. The metric that banks or lenders tend to focus on is the debt coverage ratio. So basically the debt coverage ratio says that they want you to hit a 1.25 debt coverage ratio. And what that means is they want $1.25 of net income for every $1 of expenses that the property generates. So in order to make financing on this deal work, it looks like we have to put around 38% down, which works out to $493,000. We'll also have some closing costs associated with that. Commercial loans, right now interest rates are hovering around 6.3%. So that's a little better than what you'll get on a 2 to 4 unit loan. Right now, those investment loans for 2 to 4 unit properties are around 7%. But something very important to note about commercial loans is that they're typically only fixed for 3, 5, or sometimes 7 or 10 years. Most people go with 3 or 5 years fixed, and then the loans will go adjustable. And then if we go to our summary tab, we can see some of the metrics for this deal. So if you've seen my other deals, I really like to focus on gross rent multiplier. So the property is priced at 11.17 times gross on current rents. And after increasing rents, charging for parking, you can get this property to operate at 10.5 times gross, which is great for a 5-unit and up deal. We're at $216 a unit, 357 square foot. And based on my estimates for expenses, we're at a 5.8% cap rate based on current rents, and we can get that up to about 6.3% cap rate. Scrolling down here, the way this pro forma works is we have our current rents and market rents that are totaled up here. We have our financing, so we can see our monthly financing costs and our annual debt service. And then we have our expenses here. So taxes, insurance, repairs and maintenance, property management, and basically all the expenses that a lender is going to take into account when they're calculating that debt coverage ratio. And in this section, this is our annual operating forecast. This spits out our cash flow. So we take our monthly gross rents, multiply it by 12 to get our annual gross scheduled rents. We take out our vacancy expense, and we add in our other income, so for the storage room. We take out expenses, which come from this section, and we take out our debt service, and it spits out our cash flow. So because this property has been fully renovated already, we may have a lower repairs and maintenance budget for that first year. And because it's fully occupied, if it stays that way all year, your cash flow may look a little bit better, but we'll keep those expenses in just to make things conservative. And then once you get rents up to market price, we're gonna be cash flowing around 21 grand a year. And if we back out those expenses again, you could see it could operate a bit better than that. But cash flow is really just one of the elements of return. And at the bottom here, we take into consideration the others. So we have appreciation. So this is assuming 5% appreciation on this building. This is our cash flow. We also have some tax shelter benefits. So with real estate, you get to depreciate the value of the structure. And we have equity buildup. So this is paying down the principal balance on the loan. So when we combine all of these returns, it looks like this property is returning about 20% in the first year. And that's based on our down payment and our projected closing costs. So all in, we're at about 520 grand, and we're making 103 grand between our four elements of return. So I mentioned before that there's really an interesting opportunity in the 5 unit and up space. So now let's take a look at some market data so I can show you what I'm seeing. So interest rates have increased pretty substantially in the last couple of years. But if we rewind back to 2021, I want to show you what commercial deals were selling for back then. So I'm going to show you 3 examples. This is the first. This is a 6 unit building in the Washington neighborhood that sold in 2021. So this 6 unit building sold for 1.4 million. And when we look at the description, we can see it was priced at 14.7 times gross based on current income, and you could get it to operate at 13 times gross once you increase rents. So comparing that to our subject property, we're able to buy this one at 11 times gross and get it to operate at 10.5 times gross. So that's a difference of 2 gross rent multipliers. And if you think about that in terms of pricing, the way gross rent multiplier works is it's basically multiplying the gross income by whatever multiple the market is willing to accept. So for example, if a property was generating 100 grand a year and properties were selling at 10 times gross, we would just multiply our 100 grand in gross income by the market average gross rent multiplier, and that gives us a property value of $1 million. So this property a couple years ago, if we were to sell it for let's say 13 times gross, which is what this one would be worth stabilized, this same building would have been worth, let's see, our gross rent is 114 grand times 13. So that's a pretty big discrepancy in value. So we're buying this one today for 1.3 million, and a couple years ago it could have sold for around 1.48 million. So pretty big decrease in prices for 5 unit and up buildings. But that's just the first one. Let's take a look at the next one on our list here. So this one, just outside of the Washington neighborhood in the Poly High neighborhood. This one is 7 units. It sold for 1.565 and also sold in 2021. It was priced at 15 times gross based on current rent and 13 times gross once you raise rents up to market price. So very similar to our first one. And then the last one that I have here, this one is just south of the Washington neighborhood. This one's going to be in the Wilmore Historic District. This is a bigger building, 26 units, but this one is probably the closest in terms of condition. So this has been fully renovated. It's a turnkey property. It sold for 6.68 million and also sold in 2021. It was priced at 13.85 times gross based on the current income, and there was a little upside, so you could get it to operate at 12.9 times gross. So basically what's happening right now is properties in the 5 unit and up space are losing value. And we have to ask ourselves, why is that happening? Well, it has to do with financing. So because commercial loans are fixed for shorter periods of time, a lot of the loans that 5-unit and up owners have in place are starting to adjust. So in 2021, rates were around 3%. So the fixed periods on those loans is starting to adjust, and the interest rate is just about doubling up to where it is today, which is 6.3%. So we have a lot of owners who are maybe feeling the strain because their mortgage payment is doubling. And what we're seeing is a lot more properties in the 5-unit and up space are piling up on the market. So this is a chart I put together. This tracks the number of active listings on MLS in Long Beach. And the bottom 3 lines here, this is going to be duplexes, triplexes, and 4 units. So we can see inventory has been pretty flat over the last year, but has actually decreased a little bit going into the start of 2024. And 5-unit and up inventory is starting to build. So 5-unit and up buildings are starting to get harder to sell. And part of that is there's more people wanting to sell those buildings. And part of that is there's less buyers who are able to buy those types of buildings because you do need bigger down payments. The property that we were looking at today is one of the most affordable 5-unit and up sales to happen recently. And with that property, we needed almost 40% down. So there's not a lot of buyers who are able to come up with that kind of cash who are in the market today. So 5-unit and up owners are having to drop prices a little bit. Also, there's a lot fewer owners who are trading up. So people who own 2 to 4 unit buildings who may have been interested in exchanging into the 5-unit and up space, a lot of those owners refinanced when rates were low. So they were able to fix their loans for 30 years at 3 to 4% rates. So these owners are holding on to buildings instead of exchanging up into the 5-unit and up space. But I think if they look at what's happening with values, they may start to be interested in doing that type of exchange. One other chart that I wanted to share is this one. So this is a chart from CoStar, and CoStar is one of the biggest multifamily data companies out there. They tend to track just 5-unit and up sales. So this is a chart showing cap rate projections in Long Beach. And what you can see going back to 2024 is that cap rates have started to fall in 2014, and they basically kept falling up until end of 2021. And a lot of that had to do with interest rates being cut. So especially in 2020, you can see this is when COVID happened and rates were cut down to 0. We can see a really sharp decrease in cap rates. And then as rates started to increase, we're seeing cap rates start to go up. And as cap rates go up, that means prices are coming down. So CoStar has some projections here for the next couple years. We're expecting the Fed to ease and cut interest rates at some point. I think CoStar is projecting that to happen sometime in late 2024, mid 2025. So you can see that cap rates are projected to start coming back down. No one can tell the future, so we don't know if this is going to happen for sure. But for people who are able to buy in right now into this 5-unit and up space, they may have an opportunity to refinance at lower rates or experience increase in property value as cap rates go back down. So very interesting times in the multifamily space. I'd love to hear what you think about this particular deal and about what's happening in the market in general. Please leave your thoughts in the comments. If you got any value out of this video, please remember to like and subscribe. I'm putting one of these rental analysis videos out every week. And if you have any properties you'd like me to do a similar video on, I would love if you'd send them my way. And lastly, remember, invest well, trust Cody Charnell.